morning. How are you?
I am doing just fine on this lovely Tuesday. How are you?
Well, it is a lovely Tuesday.
All right, well, and what's more lovely about it is we have some awesome news about the interest rate market. Dale, where are we sitting right now on 30-year fixed rate mortgages?
Well, right now it's sitting at 6.01%, keeping in mind that is an average, of course. All credit scores, points, no points, etc. And the 15-year sitting at 5.35, which is quite frankly almost, what, a 2-year low, I think? Or pretty darn close.
Yeah, well, we're definitely at a 1-year low. As you can see, the 52-week range, we are the lowest point we've had in over a year. And I think we're pushing at least in 2 years. It could be more. The point is, we're seeing relief. We're in a really good spot as a market. And if we're going to talk about sustained market, if we're going to talk about the future, let's ask the experts: Fannie Mae, National Association of Realtors, MLS, Zillow, Wells Fargo, so on and so forth. They're all predicting that this right here is probably where the market is going to be. Fannie Mae and NAR, they're saying this is the lowest it's going to be. We think this is where it's going to be. All the others, they're kind of predicting higher rates. Now, MBS Highway, that's this organization that we as loan officers follow. They give us news every morning. It's kind of like the Bible for us. Every morning we watch this. They're giving a very rich estimate. But that being said, if, I'll give you this analogy. If you're walking around and then 10 people stop you and say, hey, there's a stain on your shirt, you probably got a stain on your shirt. In the same way, if all of these organizations are coming out and saying interest rates are probably going to be around this 6% range, that's probably where they're going to be at least for the near future. And the reflection of that does end up in mortgage-backed securities, Dale. I mean, I don't really see anything significant on here. Really small movements day to day for the last 3 months.
Yeah. It's been relatively flat, for lack of a better word. I know there's some bumps in there, but it's been relatively flat. Back to the previous slide, I do believe, as you do, the 5.6 is probably a little generous, but who knows? We'll see. That'd be great if it does.
I would be happier than ever could be, because that's going to mean that a lot of people are going to be able to buy a home. A lot more buyers will be unlocked. And Dale, again, I've said this to you before, but you must feel like a prophet, because we said this would happen over 6 months ago. More buyers enter the market, interest rates are dropping, all of a sudden home appreciation is going up, and in kind of a significant manner. So this is basically like, hey, realtors, hey, buyers especially, you got to kind of start riding this wave now, or else it's going to be another situation where home affordability becomes more and more difficult. Yes, interest rates have come down. Everything is now a little bit more affordable in the housing market, but for how much longer will that actually be the case? Dale, can you kind of parse out what I'm saying?
Yeah, it's almost like a vacuum, right? Whenever there's a void, that void will get filled. And what happens is rates come down, so therefore, just throwing numbers out of my head, the payment at 6.5% on a $500,000 loan is probably very similar to 5.5 to 6% on a $550,000 loan. And so when you can afford this much, but rates have come down, then you can afford a little bit more, and that's going to help drive up some houses pricing. So we really need to keep an eye on that.
Yeah, and to kind of add a little bit more emphasis to what you're saying, Dale, this is a comparison of active listings from today versus pre-pandemic. Yes, there's a lot of states and there's a huge breadth of percentage differences. Like if you're taking a look in, let's say, Texas, 33% more listings today than pre-pandemic. But here in California, we have 6% less than pre-pandemic levels, meaning the market is still a little bit more sparse than what we had all the way back in the crazy days, which means as buyers enter this marketplace, there is going to be even more demand for the houses that are on the market because there's just not as much as we've had before. So all of this really puts the emphasis on, Dale, that if you're a buyer or if you're a realtor and you have buyers that have been on the fence, you really got to get them in the market now so that they can take advantage of what's presumably the lowest interest rates that we're going to have in the near future, and for the fact that inventory is sparse and appreciation is rising.
Yeah. Very well said.
All right. Well, thank you, Dale. I hope you have a great rest of your day.
Thanks. You do the same.
All right. Take care.
Bye now.